to Unlock the Stock with Astoria Investments today. Unlock the Stock is specifically formulated for retail investors to gain access to corporate management and to get to know them and their companies better. This event is sponsored by AltX, a stock exchange that plays a vital role in the progression of South Africa's financial markets. It is the second largest stock exchange in Africa as measured by market cap, with over 107 securities listed on the platform currently, including 21 top 40 stocks with a combined market value of some 6.5 trillion. There is no cost, risk, or additional regulation for a secondary listing on AltX, and it provides issuers investors with the opportunity to save money. The team at AltX is proud to be partnering with Unlock the Stock. Just as this platform unlocks value through its insights and key analysis, AltX unlocks value for the stocks listed on its platform and helps drive the market forward. This platform, of course, would not be possible without our technology partner, RECM Global, and their website is lumiglobal.com. Please visit it to find out more about their various AGM and investor presentation solutions. Today, our host is Mark Tobin of Coffee Microcaps, and he'll be facilitating the Q&A after the presentation. Unfortunately, the finance ghost is not able to join us today, but we'll catch him next time round, so look out for that. And without any more fuss, I'd like to welcome Jan van Niekerk and Piet, non-executive directors of Astoria. But before we start this morning, a few housekeeping rules. Astoria will provide an overview through a presentation. And thereafter, you can post questions by typing them into the chat function at the bottom of your screen. This event is being recorded for the Unlock the Stock YouTube channel, which we really do urge you to subscribe to. And now I'll hand you over to Jan and Piet. And so Jan, please, if you could share your screen.
Good morning, good afternoon, everyone. It really is a pleasure to talk to you about Astoria Investments with you today. So with no further ado, I'll just kick right into what we're trying to do here at Astoria. Just as a bit of background, Astoria is a Mauritian-domiciled investment holding company. It's listed both on the Stock Exchange of Mauritius and the Johannesburg Stock Exchange. It's managed by our Mauritian-based management company called RECM Global, and has been managed by RECM Global since December 2020. It was initially managed within another investment holding company called Rech, which is also listed in the JSE. It was unbundled to Rech shareholders in April of 2021 and has since been independently listed on both those stock exchanges. What are we trying to do at Astoria? Very simply, we're trying to grow the net asset value of the business at a high real rate over time, measured in US dollars, because I think that for investors, earning good, satisfactory returns in hard currency terms is what matters. So far, so good. On the little graph there, you can see that since we took over the management of this investment portfolio, it has just over doubled in rands and almost doubled in US dollar terms. The difference, of course, is the rand depreciation. How are we going to try and continue to grow this net asset value at a high rate in dollars? Well, very simply, we can invest anywhere in the world. The mandate that RECM Global has in managing the assets of Astoria is very flexible and it's completely global. We can invest anywhere in the world. However, our network sits here in South Africa, and key to generating a good return on net asset value is the investments you make. And that is what our network throws up over time. So over time, you can expect our investments to be predominantly South African businesses. However, those businesses can, and many of our businesses operate or have operations offshore or earn US dollars as well, although they're domiciled in South Africa. So what is Astoria? It's a global investment company, as I pointed out, that partners with teams of entrepreneurs. You'll see the headline says investing with founders. That is what we do. We invest in private companies run by the founders or entrepreneurs, and we invest with them, we partner with them. Our existing portfolio of companies all have defensible moats. These are all good businesses, and these moats and the quality of the business lies in the form of licenses, brands, and scale, size. these moats enable our investee companies to generate good returns on capital, high returns on capital, in fact. And very importantly, all our companies can reinvest their profits to continue growing their business and generate further high returns on the reinvested capital as well. And finally, we're all aligned. Jan and myself own 22% of Astoria. We have bought those shares with our own money gradually over time, as and when we could do so. We do not have stock-based compensation. There are no options and no free options. We have bought 22% of Astoria gradually over the past, effectively via RECM initially, over the past 12 years, as and when we could. So we are invested in Astoria, significantly invested, and the management of our underlying businesses are all invested in their businesses as well. So you have two layers of investedness, if I could put it that way. Going to the next one. Good. So value creation is what we do. I think the middle point there is key. We in Astoria invest in private businesses. It's very different investing in private business to investing in listed businesses. Many of you would know that both myself and Jan, in the listed market, we also manage funds. In the listed market, we are known as value investors. What that means is we buy assets cheaply at prices well below what we think the assets are worth. And the stock market gives you, the listed market gives you that opportunity because the liquidity of the market helps people realize their emotions over time. So when people get very depressed, they sell because the liquidity is there to sell, and when they're very optimistic, they buy because the liquidity is there for them to buy. So liquidity helps them express their emotions, and it's those emotions which drives the share price of listed companies above and below their fair value over time. There's also things like distressed sales, or when somebody gets into trouble with debt, they have too much debt, they're forced by the banks, the debt holders, to sell their assets, which provides opportunities to invest in businesses below the intrinsic value. But in Astoria, that's not what we do. In Astoria, we believe the relationships with the management of the companies that we invest in matter. We believe in paying a fair price and then working with these management teams as long-term partners to generate value through the growth of the business. So we are partners to these companies. We're not managers of companies. We can't walk into Outlaw Investment Holdings and help Marco manage his business because we are not retailers. But we can act as sounding boards when big decisions need to be made. We can help the access to capital, the structuring of the access to the capital. Those are the sort of things we can do as a partner to the business. And that's how we create value in investing in private businesses like the ones we have invested in. And you can see in the pie chart there, we own basically stakes in 6 businesses. Outlaw Investment Holdings is our biggest investment at 43% of our net asset value. Gold Rush, well, the second biggest is actually our diamond mining business, both land via TransX and TransX Marine, which is the ocean-based diamond mining business we recently acquired. Gold Rush, which is one of the biggest alternative gaming companies in the country. Isaac Carstens, Vehicle Care Group, which finances second-hand car dealers and cars themselves, and also Liat Corp. But Jan is going to speak in more detail about each one of these businesses, and you'll see how we work with these businesses to create value. So with that as a background, I'm going to hand over to Jan.
Thanks, Piet. I think I just want to, before I speak about the specific companies, touch on something Piet mentioned, and which as an investor, you would be concerned about is how do I make money out of owning Astoria shares over time? And I think the important thing here is to say that Piet and I do not have to be sharp in any transactions and trying to grab a good deal from anybody. The underlying companies, because we intend owning them for a long time, these companies have the ability to reinvest their capital in their own businesses at higher rates of return, which gives us growth in earnings over time, which is the one thing. But the more important bit is when we think about the value of that earnings sometime in future, when we value those companies for our half-yearly results and our full-year results, we discount those earnings at quite high rates of return, which means that 100 Rand in profit that Outdoor Investment Holdings will make 2 years from now, in our net asset value today is probably stated at 70 Rand. So by the time 2 years from now rolls around, the 70 Rand that we value today will be valued at 100 Rand in our hands. So that's the unwinding of our discount rates in the underlying portfolios. And in valuing these portfolios, because as an investment entity, we give our investors an indication of what we think the fair value of the businesses are by disclosing our net asset value, and we update that net asset value 4 times a year. At full year and half year, we do a full review of the assets, but in September and in March, which is the quarter ends, we only amend the net asset value for the listed assets and for currency movement. So we don't revalue every quarter. But every time we value the assets, we try and give an idea of what we think is a fair value, but that would err to be on the conservative side of valuations. And those of you, I've seen a couple of the names on the call today, friends of the business, you know that that's been the approach that we've taken over time. So if I can spend a few minutes on each of the underlying businesses to give you a sense of why these companies have the ability to generate good returns on capital, and then we can go over to Q&A, because I think that's probably the more interesting part of this. So Outdoor Investment Holdings controls a retail group called Safari and Outdoor, which currently have 5 mega stores, 4 of those in the Joburg area, 1 in Stellenbosch, and we've recently opened a small concept store in Nelspruit. We also, in that group, independent of the retailer, the retail chain, we also have 2 wholesalers, import and wholesale distributors called Formalito and Inyati Supplies. They import and distribute products related to the outdoor and hunting fraternity. They do obviously sell to Safari and Outdoor, but they also distribute into the rest of the hunting industry and the other retailers. We also have a chain of mega pet stores called the Family Pet Center. And more recently, the group has started developing their own brands, which we mostly in the clothing, but we've recently also added a small manufacturing brand, which is related to hunting equipment. So that's the makeup of Safari or Outdoor Investment Holdings. It's a retailer, 2 wholesale distributors and importers, and then also a growing portfolio of brands. And what the brands help us to do is we can earn higher margins out of the products that we sell through the entire chain into the hunting fraternity. So this business is mostly focused on a very specific niche in South Africa, and that is a group of people that like the outdoors and or hunting. This is aimed at the higher LSM in South Africa, and that means that there's a strong fashion theme to what we sell in the retail stores at least, and then the rest is consumables and equipment into the hunting experience.
I might just add that I'm not a hunter at all. I don't like hunting, and I love going to Safari and Outdoor. I think it's a wonderful shop, and I can urge anyone, if you ever drive past a Safari Outdoor shop, go in there. There's some good stuff to buy.
There's definitely something for everybody.
Yeah, that's right.
Absolutely. So in terms of the current performance, last year was an exceptional year for Safari. Through COVID, we saw sales grow significantly in the retail and the distribution business. And we thought that was a once-off. And then after COVID lockdowns open up, growth kept going. So the businesses as sales grew by another 16% the year after that. And what happens with these businesses, and I think Piet referred to upfront, is some of the moats here is brand and scale and licenses. And Safari have all 3 of those. About a third of the products we sell in the business are sold under license. So that's hunting equipment and ammunition. The other 2/3 are sold in front of house. The business have built a very strong brand, and we now have scale, which means as your top line grow, it is a more profitable business. And that's why you'll see that the earnings grew faster than the sales. In the last year, the profit was up 45%, and we value this business on a 6 times multiple on your earnings before interest and tax, and then we make adjustments for debt and assets on the balance sheet, and that's how we valued it for as long as we've owned the business. And that means that our share, which is 40% of the business, is valued at $20 million, and that's the single biggest asset in the business. How does Outdoor Investment Holdings keep on creating value over time? Well, on the retail side, it's stock turn and margins. So the more money we can have in stock and the better margins the team can generate because they have a strong brand and scale. That means they can grow sales and they can grow their profits and they can reinvest that. We can open more stores in South Africa. We don't think there's space for more mega stores. The Nelspruit store is a concept to try and see whether we can roll out smaller stores. So that store's been running for about 9 months. We'll have to see how the first full year trades out. If that's good enough, we can open more stores in South Africa. The business has the opportunity to grow its footprint in other areas. And of course, Family Pet Centre can also grow its stores over time. The diamond mining operation consists of 2 angles. The one is the old TransX business, which is the land-based diamond mining business, which in essence owns a third of a diamond mine in Angola called Sumuluana. But importantly, TransX management, the skilled miners and operators run the mine in Angola, and we control the cash flow and the profits. And then there are some assets still left in South Africa in the lower Orange River area. And TransX also have mining rights on the west coast of South Africa, which is important. And then recently, Astoria and our partners in TransX bought a company that was then called IMDH, has now been renamed. The whole group there, we refer to it as the TransX Marine Operations. And that basically is a company with 3 mega ships, four vessels that operate on the west coast of Africa and South Africa and Namibia, and that's Marine Diamond Operations.
The picture you can see there is our second biggest ship. It's not our biggest ship.
So, and the team from TransX is very much involved in guiding how that business is being managed. That business was bought in August last year. And by the time we released our full year results, the best comments we could make is that the business is operating in line with our pre-feasibility due diligence and business plan. So we're comfortable that the operations are going well. The difference between land-based and marine-based diamond mining is that on the marine side, there's much more certainty in how many diamonds in the carats that you generate over time, whereas the land-based alluvial diamond mining is a bit more uncertain. It's much more lumpy. So the 2 businesses together complement each other if we look at the full diamond operations. Last year was a good year again for TransX. First of all, higher oil prices meant there were more dollars available in Angola, and that meant that the Angolan operations were able to pay cash into the head office in South Africa. We discount any dollar assets in Angola quite heavily. You can see there's a 32% discount on the net asset value place. So as soon as those dollars leave Angola and come to South Africa, the money increases in value. And that's part of how our net asset value grow with our investment in the diamond operations. And we think in the same way, the marine diamond business will generate a consistent flow of diamonds that will be sold for profit and come back as cash into the business that could be redeployed. Our third largest investment is through the listed pref shares of RECM Global, or Rech, which now has a single biggest asset. The only asset left really is Gold Rush. As Piet said, this is the 3rd largest gaming operator in South Africa, but certainly the biggest alternative gaming business. Gold Rush have licenses to operate bingo halls, which are entertainment areas with somewhere between 90 and 180 slot machines, which we own and run and control ourselves. We have limited payout machines, so there's licenses of 4,200 or 5,500 machines that we can roll out. We're at about 2,500 at the moment. Those are slot machines that go into sports bars mostly. And then we also have a retail sports betting business, and that's where people walk into one of our shops and place a bet on the outcome of a sports event or on a lotto. And then we also have 2 licenses on which we run online betting. We can't call it online casinos, but it's very close to what you will find if you go to a real online casino. So it covers the whole gaming spectrum in South Africa, short of owning actual casinos, which means that the capex requirements are lower, and it means that the returns on capital of these businesses are much higher. So Gold Rush is owned by Rech. Rech is in a closed period at the moment, so we need to be careful about what we can and can't say at this stage. Rech's results should be out somewhere in June, but we're happy to talk about general parts of the business, understanding the business. The way Gold Rush is valued in Rech is on a 7 EBITDA multiple, and we make an adjustment to the balance sheet. And at year end, you can see, everybody can calculate that the Rech preference shares traded at a discount to the disclosed net asset value. In Astoria, we value the Rech preference shares at that listed price. So we don't value it at the Gold Rush price. We value it at the discounted price. The fourth asset is a 49% share of the Isaac Carson's Academy. This is a 45-year-old school that mainly trains young women in somatology. So that's the beauty area of education. Most of our qualifications are a 3-year qualification where the students come to one of our campuses, one in Stellenbosch and one in Pretoria, and they get trained. And the one attraction here is that the founder of this institution, who was Miss Isaac Carson's, was insistent that we don't just train the students in academics, but also in business skills. So the business has built a very strong reputation in that once students leave at the end of 3 years, they can either run their own business or work for someone that is running their own business. Many of our students leave after 3 years and go and work on ships, cruise ships overseas. And that's how they earn, the money back from what they spent in their education. We value this business on 6 PE in terms of the school, and then we value the property separately. We think it's important to keep the two separate, so there's no double counting in there. Isaac's capacity at the moment is about for 650 students in total. You can see last year we had 523. This year the students are up to 579, and the student numbers grow at about 10 to 12% a year. And on top of growing the student numbers, we've been able to increase the tuition fees in line or ahead with CPI inflation, because there are some expenses coming through on the property side that we need to recoup. Again, the way in which Isaac Carson's will generate an increase in value is by servicing more students and by the value of the properties growing because we can pay more for the rent in those properties. The second last company is the Vehicle Care Group, and basically what we do here is we provide 2 types of services to the used car dealer market. The one is that we provide working capital to people that run their own used car dealerships, basically people that compete with the likes of We Buy Cars, which I think everybody knows about at the moment. And that means that we will provide them 3 months, so short-term loans, at very competitive rates for us. So it's quite expensive money. So we charge them expensive interest rates. Interest gets paid at the end of every month for 3 months. At the end of 3 months, the capital get returns. We find that the average life of a loan here is about 69 days. So the money is never out really for 3 months or longer than 3 months. And that means that we need to recycle the book regularly, and it means that our credit is always fresh. So there's unlikely that there will be any credit surprises for someone that has a bad loan that's been running for 3 years and we didn't know about that. So that's quite an attractive business. This is a service that has a need in the industry as the used car dealerships are competing with new competition, the likes of We Buy Cars, and therefore, there's a big niche for us in that business. The second leg here is where we have a rent-to-own vehicle renting business called Flexi Drive, where some of the customers that cannot afford to outright borrow money from banks, we can then purchase those cars and rent it out to people over a 5-year contract. And in those 5 years, they have the opportunity to buy back the car from us at any time. There's an amortization schedule, so people can buy back that car anytime. And that's a rental agreement. And we find that it's quite a lucrative alternative for people that cannot or don't want to get bank funding. There's a whole group in South Africa that want to use it. This has grown quite rapidly. We started this business in August 2020, and we're up to almost 600 vehicles at the moment. So that's growing quite rapidly. So we think that these 2 services, and there are other ancillary services, but those are the 2 drivers of the group, of the value over time. Because this was an early stage investment, the way in which we provided money to the company was through shareholders' loans rather than equity upfront. So we take a look at what the shareholders' loans are worth, And because this was early stage, we valued the equity at zero. The business has now become cash flow positive in the last 6 months or so. So we expect that the end of December was probably the last time that the equity was valued at zero. By June this year, if the business keeps on tracking the way it is, we expect the equity value to start growing, and we expect it to grow quite a bit. The last business is Liat Corporation. This is one of those where Piet mentioned that some of our businesses have operations. The company designs, manufactures, develops, markets, and sells protective gear for people that are involved in extreme sports. The reason why we are involved here is that the management team and the founders are South Africans. The technology was developed in South Africa. They started selling their products, and as it turned out, more than 90% of Liat sales are outside of South Africa at the moment. So it's a truly global brand. Initially, it was very popular with the hardcore enthusiasts of motocross and so on. And then somewhere in the last 3 years, the brand had become incredibly popular, and the business have now branched out into many other lines. You'll see some more products coming into mountain biking and other fraternities. Those of you that watch biking will know that the team that came second in the Epic this year was a Liat sponsored team, and they wore Liat kit. It was designed specifically for mountain biking. So this is a business which have grown its net asset value from, I think, originally they raised 10 million or 12 million rand in 2003, and without any outside capital, they've grown the net asset value of the business to over $22 million in the last couple of years. It's got a fabulous business model. We think it's got a big market and a long growth potential. We made our initial investment into Liat sometime last year. In terms of their performance, they've had a temporary slowdown in sales in the last quarter. As the supply chains ebb and flow around the world, the retail channel below Liat, so the retailers, distributors, have had lots of stock which they've been unable to sell into the market at the pace that they anticipated. So Liat sales dropped a bit in the last quarter, and we suspect that might be the case for a couple of quarters more. We think this is a great business with great business economics. We rate the team that run the business, and as we said at the bottom there, we would like to find a way to increase our stake in this business at the right price over time.
I think it's important to say that although it is listed, and it's listed on the NASDAQ, over-the-counter NASDAQ in the US, it doesn't trade very much. So it's almost just like a private company. It isn't a liquid.
Yeah, the shares basically trade by appointment. So I guess for individual retail investors that have an account in the US, you might be able to buy 100 to 200 shares, but to buy the size that we would want to, you practically have to do transactions, dedicated transactions with everybody. So before we go into Q&A, Mark, we think the net asset value per share of Astoria will grow over time because each and every one of these underlying businesses have a stream of cash flows into the future, which we have discounted at fairly high rates. So just by making the profits over time and that becoming more valuable as you go through time, that will increase the net asset value of the businesses. Most of these businesses have the opportunity to take the profits they make in any year and reinvest it in their own business in the form of more stock for the retailers, more financing at VCG, marketing expenses to get the brands up. That's what we expect the management teams to do, and that's the few things where we can help them. The nice thing about the setup is if one of the companies have extra capital on their balance sheet, which they cannot deploy in their own company at the rates of return that we expect over time, we can get that money back to the shareholders, which means Astoria will get cash in the bank, and so do our partners. And we can then deploy that cash with some of the other companies that have the opportunity to earn very high rates of return. So Piet and I don't have to do anything sharp or special in terms of transactions over the next 5 or 10 years. And the net asset value per share here will grow at a handsome clip. And then on top of that, yes, we will get opportunities to buy a tuck-in acquisition of one of the underlying companies or add another line or develop a new product. And we might have the opportunity to buy something cheap and we might sell something expensive. But I don't think as a shareholder, you need to rely on us to do very sharp corporate finance transactions. to grow the net asset value over time. And therefore, if you buy the share in Astoria, we expect the share price to track that net asset value per share over time, irrespective of where the discount is. Just as an aside, the last point there is, those of you that have followed Astoria for a long time will know that this company was not set up by ourselves. It was set up by an asset manager competitor of ours at a time when people were quite anxious about the rand, like they are at the moment. And at the time, Astoria received pre-approval to take money out of the country. And we still have over $280 million, which is close to 5 billion rands of pre-approved exchange control allocation. So to the extent that we need to or have to or want to take some of the capital out of South Africa and invest it in other parts of the world, we have that ability to do that. So, some people might think that's valuable. We don't think particularly, as Piet said, we don't invest Astoria in a way for us to leave the country or to think that we can make better money in offshore markets. Our network is in South Africa, but that is available if we need to, if we want to do any investments that way. That's I think the conclusion of sort of the strategy, the people involved, and some of the businesses. So, Mark, if we can go on to some of the questions, perhaps that's the next step.
Yeah, thanks, guys. Let's jump straight in with the first one. I think the first one is a kind of a pertinent question. A lot of the businesses that you've invested in, the management teams or the founders are still involved there. So, I mean, how do you guys think of, kind of key man risk or key management risk of, these guys falling under a bus, or, deciding they've had enough of this journey and, want to retire or maybe go off in a different direction, and what that means for the underlying portfolio businesses, as a risk looking down from on high at Astoria's point of view?
I think the first thing is, part of why we can earn decent returns, Mark, is because we are prepared to accept that risk and manage it. And the way we manage it is that part of the role that Piet and I have in the boardrooms of these companies is that we are part of facilitating that transition. So on top of helping with capital allocation decisions and other strategy, we also perform almost the super HR role, which is we help management teams and founders to transition to new management teams. And I think most people think it's very sexy and it is glamorous to bring in a new management team. It's actually very, very hard work to try and get a younger generation or a next generation of management to take over from founders in businesses that they have started themselves. We've done that now for 12 years over many times. Sometimes it doesn't work and we try again, but most of the times we have succession lined up, and part of our role in the business is to make sure that succession kicks in.
Yeah, I think I might add that the management teams of our businesses are generally, to a lesser great extent, fairly significant shareholders in their own businesses as well. So they wouldn't just up and walk away tomorrow. I mean, that's unlikely to happen. Where there is a change of management, it will be a process driven by the existing management team. And if we can assist, we will do so. We have done so in the past, but maybe they've got their own processes in place. So it depends on the situation.
Next one's around VCG. Obviously, as you alluded to in the presentation, it's had a fair clip of growth. Just, where does the funding for that business come from? Is it internal funds that you can use to manage the book, or is it coming from internal plus, warehousing facility or a bank club facility? Just a bit more color on, how you can fund such rapid growth, given, it is quite a large book and quite a large amount of cash that needs to slosh around in the cycle.
So VCG does have some of its own capital in the book, but as you marked up, we have access, and that was part of the benefit that our group brings to the company, is we have set up special conduits where we raise external funds, which is bankruptcy remote. It's removed from the balance sheet of the company. So you can almost think of VCG as an asset manager. So there are pools of capital that we raise from institutional and private and other sources. and that capital has been lined up and is available for us to draw down and deploy, which means that the book can grow as you can. It's fast growth, but in the South African economy context, in the context of the market in South Africa, it's still very small. So that business can grow significantly more, and we have the funding lined up from third parties.
Okay, then a question on a sweet spot in terms of size. I know you kind of alluded to your networks here in South Africa, but you're not ruling out international investments. But in terms of size, is it something that would chew up let's call it a starter position if we want to use portfolio terms of a 2% of Astoria's NAV or 5% of Astoria's NAV, or is it completely dependent on the opportunity that comes across your desk?
Yeah, I think it's opportunity dependent. This is not a portfolio managed for a pension fund which has risk metrics relative to an index. This is a bundle of equity ownership in great businesses. At the moment, there's 6 of them. In future, if something happens, we sell 1 or 2 of them, we get a bit we can't refuse. We might go down 3 or 4, or we find more opportunities. We might go up to 5 or 6 or 7 or 8. But there's no target or limit that we would put on that. And the same goes for size. Obviously, we wouldn't want to get involved in anything that's very small, because they take up just as much time as a big business. But as you can see from the current holdings, Outdoor Investment Holdings makes up 43% of the portfolio, and we're very comfortable with that. We think it's a wonderful business, and if we could have more of it, we would have more of it. So we don't see it as a classic portfolio of minority stakes in liquid listed pieces of paper. This is equity ownership in real businesses where we partner with the teams, and size is not a constraining or limiting factor.
I think the one thing we can add is we wouldn't want to be a 1 or a 2% shareholder in a business for a long piece of time. We would like to be at least a significant minority or influential minority in a business. So that probably, if we can write the check of 50 million, that probably gives you a sense of, there is a limit. Like we wouldn't get involved in mega caps. But yeah, so if there's a path for us to become a significant influential minority in the business, then we'll get involved.
Yeah, so we're talking an investment that's going to, give you guys a seat at the board table so that you can have your finger on the pulse, and as you say, play that strategic HR role, strategic strategy role.
Strategy, I think, is the key word.
Mark, I think just on one of the points you made is we don't need a board membership to have an influence. If our assessment is that we need to be a director of a company to have influence on the way management think, then we probably most of the time walk away.
Yeah.
If we need a seat at the board to influence, then that's the wrong partnership. I think Piet pointed out that our model is to be partners with people that run the business. So we're happy even if we're not on the board. We should have influence.
Okay. Question around the discount to NAV, topical for investment holding companies in South Africa. For the last 2 or 3 years, we've seen various strategies and various delistings. Your thoughts on it in terms of, closing that via buybacks, starting, to pay out dividends, or just, trying to do the best you can with the underlying NAV and just, let the performance speak for itself and, try and close it over time as the track record improves. Just some comments around that.
So first of all, let me say, we think the discount to net asset is a red herring. People look at this thing and say that's good or bad. We have no opinion about the discount. It is what the market says it is, and that's how it is. How are you going to make returns from investing in Astoria? I think Jan laid it out very clearly at the beginning. The first part of the returns you make from investing in Astoria is the growth of the underlying businesses, which are linked to the economy. They'll grow. We think they're superior business than average, so they'll grow faster than the economy. Let's say 7 to 10% per annum on average over time. On top of that, you get the unwind of our very high discount rate we use to value the business. As we said, We value our business conservatively. That means we use a high discount rate to convert their future cash flows to present value when we do the fair value calculations every 6 months. So you get the growth of the business plus the unwind of our conservative discount rate. That is how you will make money. Now, the market puts a 40% discount or 50% discount on net asset value. If that discount stays at 50% for the next 5 years, you are going to get the growth in net asset value. And that's fine. If the discount were to narrow, you'd get a third source of return on top of the growth of the business, the unwinding of the discount rate. You will also get the narrowing of the discount to net asset value. But that is not we don't have a strategy to close that. The market will close that because it recognizes that we are investing in net asset value at a satisfactory return. And that, these things go through cycles. It wasn't that long ago when many investment holding companies in South Africa were trading at premiums to net asset value because the market was so excited about the good investments they're making. That was also wrong. It turned out to be wrong. And we think the deep discounts they're trading at the moment will also turn out to be an opportunity or incorrect pricing, I'll put it that way. But that is not our focus. Our focus on growing the net asset value. That's our job.
Yeah, interesting. Today is probably the 2-year anniversary of when Astoria was unbundled from Rech and started trading. And if you see the net asset value in the subsequent 2 years has gone up, has doubled, and the share price has basically doubled in the same line. So despite trading at a 50% discount initially, you've had a doubling of your money over the next 2 years. So I think that just makes the point. If we grow the net asset value, shareholders will make money, and closing of a discount will be a cherry on top.
Another question then, obviously very South Africa-based businesses, load shedding is, highly topical. We've seen some eye-watering diesel bills like listed entities. Just on how you think about the impact of load shedding, what the underlying businesses are doing, and how that, kind of plays into, strategic thinking as well in terms of expansion.
I think the first thing is we accept that we operate in South Africa, which is an emerging market, and it's messy. Sometimes there's electricity, sometimes there's not. There's crime. We deal with transporting our staff safety. There's lots of stuff that we have to deal with. Load shedding is one of those things, and the management teams of the businesses are quite competent. The businesses are slightly different. So some of them can solve their load shedding problems easily by installing inverters and batteries, and other businesses can't do it that quickly because on this particular shopping mall where we operate, the mall owner has already put solar panels on the roof, and we can't add more solar panels, so we need to have another plan. What we have learned is that South Africa's economy, and to a large extent the businesses that we own here, were prepared for stages 1, 2, 3, and 4 of load shedding comfortably. I think we found out at the back end of last year and the early part of this year that we were probably not fully set up for stage 6. For instance, many people install generators thinking that a generator can run your electricity if the power goes off. That's true for a 2 or a 4-hour stint at a time. If we have to run a generator for 14 hours at a space at one of the gambling shops, at some stage we need to shut down the generator so it can cool down, and there's a period of trading that you lose. So there's definitely impact on different parts of the businesses. I can tell you in all of these businesses, our CapEx conversations at the budget meetings and the board meetings in the recent past has been, where do we need to cut down in some of the growth CapEx so that we make sure that we can operate comfortably. It is a necessity for the next year or two in terms of cash flow, but it enables our businesses to compete over the next 15 or 20 years. So it's a reallocation of capital, and that's part of the decision we can help them make. The second one is we can help all the company management to say, well, this is the best solution we have found at one of the other guys. Why don't you look at this? And we can get benefits from sharing that between the different companies. So not every team have to go and reinvent the wheel themselves. So that's the benefit of talking to each other and being part of the team. The third point is that the way that electricity prices is going in South Africa might mean that it's basically spending the capex to get your own solution is now a break even is 3 or 4 years we find, and the rate it's going it might be even shorter. So we doing that, and all the underlying companies are solving their problems. There might be a hiccup for a quarter or a half year in some of these, as we have to just solve it for now, and then it's back to normal trading.
It's also true to say that we have some companies where load shedding has no impact at all.
Yeah.
Transex has no impact on Transex, has no impact or very little impact on Liat. It has little direct impact on other costs.
And VCG.
And VCG as well.
Yeah.
So, it might have secondary impacts in terms of spending power and so on, but be that as may. I think the crucial thing that I think we as a group of investors need to think about is not what's happening right now, because what's happening right now is hard, and I think it's going to get even harder through winter. But what does the energy generation environment look like in South Africa in 18 months' time? And my prediction is that we will have a fully privatized and fully decentralized energy generation sector in this country in 18 months' time. Something the rest of the world aspires to, but they're not getting there. And we are being forced to get there by incapable government. So I actually think in 18 months' time, things will look very different, where we will have enough energy produced on a decentralized basis by the private sector, which will put us in a very strong position as an economy.
Yeah, and a question on Safari and Outdoor. You mentioned, you've got the kind of flagship stores, if I can call them that. I know the one here in Stellenbosch well. And you've started the kind of smaller concept store as a test. Assuming that that kind of goes according to plan, I mean, how, as a specialist retailer like Safari and Outdoor is, how many branches do you think the South African economy can accommodate? If we're to look 5 years out in Safari and Outdoor, do you think we can have 20 strategic locations? Be these big flagships with a few smaller retail ones in specific markets?
We think we're done with the big stores. We've looked at all the locations. We don't think there's a place to open another destination mega store like we have. We think the trading density in the existing stores can grow a bit more. The opportunity is to have the smaller stores like we have in Nelspruit. We think there's a space for about 10 to 12 of those if the concept works. But we don't think we can launch any more big ones. If that's the case and we cannot deploy more of the capital in working, stock and working capital in the retailers, then OH will just pay a bigger dividend, and that money will come up to the shareholders and we can redeploy it somewhere else. But the discipline there is not to open stores just for the sake of opening stores. We have a very disciplined store opening process where we are very specific about what the shape of the income statement should look like. We have a very specific requirement about the payback periods and what your returns on capital should be. I cannot recall a board meeting where we were not considering a premises for a new store, and most of the time the economics don't make sense and we don't proceed. So I think that's the way we can go. The family pet center business is one where we probably can get up to 40 or 50 stores, but it's competitive and more of the existing retailers are pivoting in that direction. So you need to make sure that we have the offering correct there, and that's what the guys are doing in the existing 3 stores. And until we got that right, because any one of a retailer is stock turn and margin. And then you need to manage your expenses. And if we can't get that right, we won't open more stores and we'll rather redeploy the capital somewhere else.
And another one on Safari and Outdoor, question around, could it be taken, international? So, open a shop in Bots, or, a franchise opportunity for somebody in Bots who, might have a particular interest in the product line for that market, or Namibia, not going totally all over Africa, but maybe there's scope for 1 or 2 stores, just north of the border.
So we don't think there's scope for stores in other parts of Africa. Remember that you need to have specifically the retail store needs to be where your customers live. You don't put the stores where they go hunting. By the time someone gets into the the bushveld, they're done buying and practicing and cleaning and everything. So the stores are located where our customers live, not where the destinations are. And the buying power, unfortunately, is just not there in any of the, at this stage, at any one of the other African countries. Secondly, legislation around weapons and weapons control is very different. Remember, Safari and Outdoor, we do not sell to businesses, we do not sell to governments, we do not distribute, especially ammunition, to any third party. So it's only aimed at the hunting and individual hunting retailing fraternity. So the legislation in the countries around South Africa is very different. For instance, in South Africa, a hunter and his weapons get licensed. In Botswana, the individual gets licensed and you can have as many guns as you want, but there's a limit on the number of guns in the country. So there's very specific legislation that makes it unattractive to go there. Is there space for a safari-themed retailer in Texas? Well, I guess there is one, but that's a very different proposition. I mean, just the working capital in one of those stores will be bigger than anything we have in South Africa. So international, we don't see that as going north in Africa. That will probably be in one of the other countries.
Question on, obviously a very depressed economic environment, and, we're seeing a lot of immigration. Are you seeing opportunities in, private business valuations from, people exiting an industry or indeed emigrating, and, you've kind of got forced sellers or at least eager sellers?
Not really. I think private individuals know what their business are worth, and they generally, not without exception, but generally they don't get to a position where they become a forced seller or a desperate seller or an emotional seller. So in the private world, you don't see a lot of that around at all. So it's not like the listed market where people get depressed and they sell just because it makes them feel better to sell. When you've built up a business over years and years or even generations, you are not going to sell it because you feel depressed about the future, and you're not going to sell it at a cheap price because you feel depressed about the future. You're going to do the best you can to achieve a decent price if you want to exit. So what we are seeing, especially in the smaller end of the market, is a lack of buyers, but that doesn't mean that the sellers of those businesses are just going to sell at the best bid they can. They still want to sell to somebody who wants to work with them and wants to build a relationship, wants to build a partnership, and they have a certain price in mind. And so you're not going to get stuff cheaply because people are depressed or the environment is depressed, because most business people also know that what is happening today is not what is happening tomorrow or the week after or 2 months after. Things can change.
Perhaps the one thing to add there, Mark, is there are basically three types of buyers for private businesses. The person that can afford to pay the highest price is your competition as a seller. My neighbor or my competitor can buy my business, fire my staff, get rid of the brand and the overheads, and put the turnover onto their infrastructure, so they can afford to pay the highest price. So some people, when they get and want to sell their business, it's all about the highest price, then they should be selling to their competition or a trade buyer. The group of investors that can afford to pay the second highest price is mostly private equity, people that see themselves as, I'll come and make an investment, put debt on the balance sheet, run the business hard for 7 years, and then sell it to someone else. So they typically are the group of people that can afford to pay the second highest level of pricing. And then there's us who say we want to come in and be the partner of you and the business and make sure that we invest in the business, in the brand, in the infrastructure, and we make money together over time, even if it is with a management team that takes over from the existing one. So our pricing generally, when we rationally explain to people, sometimes it's better for someone to sell it to a trade buyer and not to us. So we normally don't, but we haven't seen any panicky conversations about people wanting to leave and sell their business.
And then another question around opportunities. Obviously, we've seen a huge derating, at least in the public space, and I'm sure it's carried over into the private space for technology companies over the last 18 months. Has that, and there's no kind of, let's say, real technology businesses. I mean, Liat, you could say there's a lot of proprietary IP in there, but no true SaaS businesses, we'll say then, in the portfolio. Has that thrown up a few opportunities, or is kind of technology not within the kind of wheelhouse of Astoria?
I think it's probably fair to say it's not necessarily technology companies that have seen a sell-off, it's venture capital type early stage businesses where the valuations are compressed dramatically. And we are generally not early stage investors, whether it's technology or any other type of business. We're not early stage investors. We prefer to invest in established businesses and as either as growth capital or replacement capital for a founder that might want to exit or take some money off the table. But we're generally not very good at venture capital, so it's not something that that crosses our desk very much.
And then a question just on reporting. Given the majority of the investments are rand-based or are currently, any thoughts on changing the functional reporting currency just to ZAR? Or are you happy to keep with the USD ZAR kind of dual reporting with USD?
I see our colleague Dean Schweizer is on the call here. So if it was up to Dean, he would just pick one currency because it makes his life very difficult. We think it's fair to show both the rand and the dollar returns for people over time, because I think it gives a fair comparison and it keeps us focused on what we want to do. So no, I think for the time being, we'll keep on reporting in those currencies.
Remember, our aim is to grow the net asset value in hard currency, in other words, US dollar terms, because that's what investors need and that's what they want. So we'll continue reporting in dollars. And
let me just check, because I know we're pushing up on time. I just want to check if we got any further questions here. One on ISA Carsons, you mentioned, some of the students, end up on the cruise ships. Is that a kind of a key part of the marketing, that, it does offer an ability to, find work internationally as well as locally? Or how important is, I guess, that, job at the end of a course to, I'm guessing the prospective parents in most cases, but sometimes where the students are self-funded, that, there is real work opportunities when you get to the end of the 3 years?
I think the work opportunity is definitely part of it. It's not all of it. So the reason why students come to ISA is, number one, they get a student life. So they either spend 3 years in Stellenbosch with all the other university students, or they spend 3 years in Pretoria with all of the other university students, and they have their 3 years of their youth with their peers. I think the second one is the venue. Students do want to come to Stellenbosch, and I think to a lesser extent, but they want to come to Pretoria and spend time there. The third one is definitely what ISA offers is an international qualification, and I think that makes a big part of the decision for people, is that I get a 3-year qualification which is accredited and which I can apply immediately if I arrive in the UK, in Portugal, in Germany, in Spain, and any of these places, in Dubai, on the ships. So, and the earnings potential for the somatologists outside of South Africa is actually higher than in South Africa. So if you take any of the students that go on and open their own businesses, obviously depending on their business savvy, but if you spend time working in Portugal for 4 years versus running in South Africa, I think you make more money in Portugal, and I think that's quite attractive for many of the people that come to study, the fact that there's an international angle to that.
Okay, gentlemen, I think we'll leave it there because we're basically coming up on time. Jan, Piet, thank you very much for coming in and presenting to the Unlock the Stock crowd. I'm just going to hand back to Deborah now, who's just going to wrap up quickly with some closing remarks.
Thanks, Mark, and a special thank you, obviously, to Jan and Piet for taking time out of their busy schedules to support this platform, and to everybody who dialed in for the call. We always welcome retail investors to this platform, as we think it has a very important role to fulfill. And just a quick reminder, if you'd like to be added to the Astoria contact database, please just email info@astoria.mu. We certainly hope you've enjoyed this event. It was a really good debate, I think, and very informative. And if you'd like to listen to it again, it'll be on the Unlock the Stock YouTube channel soon. And just a final reminder from us is to join us for the next session of Unlock the Stock on Thursday, the 20th of April, to hear more about TWK investments. So please look out for that invitation. Thanks very much.